with recession fears now potentially becoming very real, is gold here to come to the rescue? Joining me today, Peter Hugg, Global Trading Director over at Kitco Metals. Pete, so good to have you back on the show.
It's good to be here again.
Yeah, happy to see you. We both possibly took the worst vacation week off with all the excitement in the gold market. So just want to recap a little bit of what's been happening. Let's start off with the inversion of the yield curve. There's fears of a recession now, yet the economic data we're seeing is not reflecting this. So is the data wrong, or what's out of whack here, Pete?
Well, generally, I mean, if you go by historic standards, the inversion of the yield curve generally is about 95% accurate in predicting a recession. But the recession is generally anywhere from a year to 18 months out. So, although the inversion indicates a recession is coming, and that's assuming the inversion remains in place, that can be fixed fairly quickly by the Fed lowering rates. But assuming the inversion stays in place, we'd be looking for a recession sometime in 2020.
Okay, so
in the short term,
right.
The economic data still suggests that the economy is still somewhat vibrant. So a recession, in my opinion, is probably not imminent in this year, but possible in 2020, again, depending on what the Fed does in its subsequent meetings.
Right. Well, 2020, not so far away here, Pete. So that's kind of alarming that you're bringing that up.
Well, it depends what you mean by a recession. I mean, I don't think we're going to have a 2008. I mean, I think it's possible, given some of the risks with Brexit and some of the banking issues that we're now seeing in the European Union. So it could be a serious event, but it could also just be a mild recession, which is normal in the course of economic expansion that you would get a recession. I mean, we've had 10 years of expansion, but I think the Fed and the central banks globally are prepared for a slowdown, and I think they're going to do everything in their power to inflate the money supply to keep the recession at best a minimal experience. So, I think you've got the Fed and the European central banks and the Japanese central bank basically as a backstop. They're going to do everything possible to keep this economy going as long as possible.
All right. Well, gold obviously benefiting from this news. It's dropped a little bit down this Friday, but still above that 1,500 mark. Pete, we didn't speak when gold blasted through 1,500. So I want to get your thoughts on, what were you thinking that day?
Well, I mean, again, based on our last conversation, which I can't remember, was 2 or 3 weeks ago, we suggested that if 1420 was breached, that there was minor resistance at the 1470 level, and it did bounce there a couple of days. But through there, 1520 was the target. And we've hit that target a number of times. And we, as I mentioned on Monday, I think Monday or Tuesday when I posted a blog, that I'm very constructive this gold market. I mean, there's just a lot of issues in the market. Ignoring the Chinese tariff issue, which is obviously a big issue, we have the Italian banks that are in serious financial trouble. Germany today basically indicated they were going to lower interest rates to stave off a recession. So they're going to be very accommodative as well. You've got the issue with Hong Kong and China. So there are just so many macro issues out here that suggest that you do not want to be not in the gold market. That keeps us constructive. And, as I mentioned in either my Monday or Tuesday post, I can't remember, to be frank with you, is that as long as gold can hold that 1497 level, we're constructive. And we suggested that any kind of pullback was a buying opportunity. We remain constructive the gold market at these levels. We still want that 1522 close, and we still haven't seen that yet. But I think if we get that close and it stays there for a day or two above 1522, I think the next target is 1600.
Well,
so we remain very constructive, the precious metals complex.
All right, and just some thoughts on silver, Pete. Silver has moved up, but people really want a major breakout here for silver. Are they going to get it?
I think so. I mean, it's coming. I mean, silver's moved from about a 93-to-1 ratio to 88-to-1 right now. And I mean, you know, if you're just looking sort of at sort of sideline news, we're seeing extreme retail demand for physical silver out of our Hong Kong office. And that has not occurred for the last 2 years.
Wow.
We're having trouble keeping up with physical bar demand out of our Hong Kong office right now. The mints are basically producing at full capacity. So we believe that silver at these levels, I mean, if you were going to engage in a metal, if you were bullish this market, silver at 17.20, in my opinion, is still dirt cheap.
So sorry, Pete, they're buying more silver than gold now out of the Hong Kong?
Yeah, they are. They are. But the other thing that's changed as well, as you recall some of my comments over the past few interviews, as long as retail was selling gold, I was constructive the gold market because retail tends to be behind the curve. Retail right now is about 50-50. We are starting, believe it or not, you know, they wouldn't engage in gold at 1,200. They wouldn't engage a gold at 1,100. They wouldn't engage a gold at 1,300. But at $1,500, North American retail is coming into the gold market, and it's about a 50-50 balance against sales. So people are actually chasing this market, which makes me a little nervous from a North American perspective. But in the Chinese theater, most of the buying seems to be in silver. They consider it undervalued at $17, and they're chasing it up. And again, if we get gold at 1,600, as I mentioned earlier this week, I think silver at 1,850, 1,900, $18.50 or $19 an ounce is certainly within the realm of possibility in the short term.
Wow, those are really good insights, Pete. I appreciate you sharing that with us.
You're welcome.
Yeah, and thank you for watching. Happy Friday. We'll be back on Monday.